Hyder is a banker focused on middle market M&A. What's your outlook for deal financing right now?
We're seeing the middle market debt financing market very active, very vibrant, probably more so than we've seen in years. The debt multiples are between 5 and 5.5 times, a lot of them creeping up to 6 times, which is great. And we're seeing more competition amongst lenders. Lenders are getting more aggressive trying to put their money out in these deals. And you know, they suffer from the same problems that other capital providers suffer from, is trying to find alternatives to put their money when Fed funds rates and other alternatives are so low. And corporate lending is actually a pretty good place for them to be, particularly with the economy in a more stable state and more optimism in the future.
With debt so freely available, are you seeing more favorable debt terms?
Well, we are. With debt multiples going from 5 to 5.5 to 6, we are seeing some of the terms also get stretched. The spreads are still pretty good, but we're starting to see some covenant light deals. Not as crazy as in the last cycle, but a little better.
Do you think any fears about upcoming tax changes may impact deals this year?
It is clearly fueling volume this year. We're seeing our backlog at Harris Williams up about 60% from this time last year. And it's almost the exact same trend as the 2010 deal activity, when capital gains rates are feared to go up and carried interest tax rates are feared to go up. It really influences people to hurry up with their deal and push it into this tax year.
Is there any other sort of regulation that might be impacting deal making right now that you're seeing, like any concerns about changes to Dodd-Frank or healthcare reform?
No, I think the biggest driver of the activity is really the capital availability. Corporations have more capital and cash available for deals today than they ever have in the history of man. And they have no place to put it. With organic growth at a slow and moderate pace, acquisitions are really the place to put your cash versus, say, building a new plant. Private equity groups have more money than they've ever had, and the debt market is certainly fueling activity. So you put all this together, plus the tax change concern, and you really have the makings for a historic year, and we're certainly seeing it.
You know, I've been hearing that for a while now, that private equity firms, corporations, they have a lot of cash. But what do you think it's going to take for them to deploy it?
Well, they're putting it out pretty quickly. Our volume is up, you know, over 60% this year, and the competitiveness for these deals from corporations and private equity groups is tremendous. In fact, I would say that they are more at parity and competing for deals today than they ever have been. So private equity groups are equal to corporations in trying to get the cash out because they have nowhere else to put it.